The banks and the governments are lying to you. They tell you how good and financially viable it is to buy properties through mortgages. But is that really true? Should you buy properties or just rent them, retaining your freedom of movement? In this video, we'll compare mortgage and rent to finally find out what's best for you. First, I must say that everything you hear in this video is not financial advice. We are neither an investment advisory service nor an investment advisor. Data and information provided are solely for educational purposes. Anytime people are thinking about buying the house, the whole decision making when it comes to financing revolves around the mortgage rate. It's an important factor to consider when buying a home, as it can have significant impact on the total cost of the loan. The mortgage rate can be fixed or adjustable, and it is typically expressed as a percentage of a loan amount. The higher mortgage rate will result in higher monthly payment, while a lower mortgage rate will result in lower payments. Mortgage rates are influenced by a variety of factors, including the state of the economy, the lender's risk profile, and the type of mortgage being offered. For example, in times of economic uncertainty, lenders may charge higher mortgage rates to mitigate the risk, and that's exactly what we should focus on. The times of economic uncertainty. We live in these times now. The inflation is at its highest in 40 years, bloated cost of living, Fed's interest rates are breaking records, and mortgage rates have almost doubled in a year. It's true, in the beginning of 2022, the rate for a 30-year fixed mortgage was around 3.5%, and now it's over 6.2%. For a 15-year fixed-rate mortgage, it's 2.3% and 5.6% respectively. The rate more than doubled. We haven't seen such high rates since the housing bubble of 2008. But how much will it actually cost to buy a house? Let's open a website and see how much will it cost in California and in Texas. So, California. Here is a good house. 1,500 square feet, 3 bedrooms, built in year 2000. Good enough interior, $315,000. If we say that you want a 30-year mortgage at current 6.2% and can pay 20% down payment of $63,000, your loan of $252,000 will ask for $304,000 of interest, which will make the total price of a house of $619,000, and you'll pay it off in 2053 with a monthly payment of $1,800. Okay, now Texas. Similar house, 1,260 square feet, 3 bedrooms, quite nice on the inside, $289,000. In Texas, you'll pay $1,930 a month, and with a $58,000 down payment, in 30 years you'll pay $278,000 of interest, making the total house cost of $568,000. Of course, mortgage rates can change over time, even for borrowers with a fixed-rate mortgage. This can occur if the borrower refinances the loan, or if market conditions change, resulting in the change in the lender's risk profile. However, that's 30 years of being tied to one location, one house, which for some people is a deal breaker. Okay, but how about rent? The amount of the rent is generally determined by the size, location, and condition of the property, as well as the demand for rental properties in the area. In addition to paying rent, renters may also be responsible for paying utilities such as electricity, gas, water, and internet. These costs can vary depending on their usage and the specific terms of the rental agreement. Some landlords may require tenants to pay a security deposit at the beginning of the tenancy. The purpose of the security deposit is to cover any damages to the property or unpaid rent that may occur during the tenancy. Landlords are required to return the security deposit to the tenant at the end of the tenancy, minus any deductions for damages or unpaid rent. Renters may also be required to purchase renters insurance, which covers the personal belongings in the rental property in the event of a covered loss, such as theft or natural disaster. It is not uncommon for people to rent a house for a short period of time, such as a few months or a year. However, some people do choose to rent a house for a longer period of time, such as several years. There are a number of reasons why someone might choose to rent a house for an extended period of time. For example, they may be unable to afford to buy a house at the moment, or they may prefer the flexibility of renting to the commitment of owning a home. In some cases, people choose to rent a house for a longer period of time because it allows them to live in a specific location that they might not otherwise be able to afford to buy a home in. Let's look at costs once again. California, Los Angeles. Roughly the same location, 3 bedrooms, 1,300 square feet, $2,000 a month. In 1 year of rent, you'll pay with all utilities and other expenses roughly $25,000. If we assume that the price will change 3% every year, a 30-year lease will cost you around $1,180,000. How about Texas? 1,500 square feet, 3 bedrooms house in Austin, $1,500 a month, $19,000 per year. In 30 years, you'll pay around $900,000. Seems like a lot more than purchasing, but where is that line? Let's compare renting and buying using one of freely available online calculators. California, 30-year rent versus 30-year mortgage. The calculator says that if you are planning to rent for 30 years, buying will be cheaper after the first 5 years. However, this calculator doesn't account for years when rent price decreases. For rent with fixed payments, that can last years, and so on. It's a pretty rough calculation, but even if we take into account everything, buying will still be cheaper if the rent lasts over 10 years. And Texas, if the rent is longer than 11 years, it's cheaper to buy. Even if we make that 15 years, it's still cheaper. It seems like money-wise the winner is obvious, mortgage, but are there any other factors that can make a difference? Buying a house through a mortgage or renting it are both viable options for securing a place to live, but they come with different financial considerations. A home with a mortgage allows a person to build equity in the property over time, as each mortgage payment reduces the amount of the loan and increases the homeowner's ownership stake. Additionally, mortgage interest payments may be tax deductible, which can save money on taxes. However, obtaining a mortgage can be a lengthy and complicated process, and it requires a substantial down payment and good credit. Additionally, homeowners are responsible for maintaining and repairing the property, which can be costly. On the other hand, renting a home or apartment has a lower upfront cost, as it typically requires only a security deposit and the first month's rent. Renters are not responsible for maintaining or repairing the property, as that is the landlord's responsibility. However, rent payments do not go towards building equity, and they are not tax deductible. Additionally, renters may be subject to rent increases and can be asked to vacate the property by the landlord, which can make renting a stressful endeavor. Alongside these pros and cons, we should consider the future. Housing market is currently not in the best shape, with overvalued prices and low demand. The date when this bubble will burst is only a question of time. Home prices will go down significantly, as we've seen in 2008, and after that, the house that now costs $300,000 can cost up to $200,000. Not bad for a few years of waiting, right? As for the rent, it also fluctuates a lot with time. Look how the median rent cost was stable for years before skyrocketing after COVID. Of course, such global events don't happen very often, but it's something to keep in mind. Ultimately, the decision to buy a home with a mortgage or to rent will depend on a person's financial situation, their ability to secure a mortgage, and their long-term plans. For some people, renting may be a more practical option because it allows them to save money on a down payment, avoid the costs and responsibilities of home ownership, and have the flexibility to move to a new location more easily. Renting can also be a good choice for those who are not ready to commit to a long-term mortgage or who are not sure if they will be staying in the same area for a long period of time. For short periods of time, up to 5 or 10 years depending on the location, renting can be more financially viable than buying. On the other hand, buying a home can be a good investment and provide a sense of stability and ownership. It can also be a good choice for those who are financially stable and plan to stay in the same area for a long time. Owning a home can also provide potential tax benefits and the opportunity to build equity over time. Ultimately, the decision to rent or buy should be based on what is best for your preferences, capabilities, and specific circumstances. We strongly advise to seek assistance from professionals when it comes to getting a mortgage or choosing between renting and buying.